Good afternoon, seventh hour. Happy Friday, January 13th. Here's our agenda today while you guys are working remotely. You can go ahead and skip the market report if you want to Google search it and find it and watch it on your own. Have at it. Perhaps in the future, I'll make sure to link it so you guys can watch it, but that is from CNBC. We have a quick lecture here on treasuries, government bonds, the difference between government bonds and corporate bonds. And then you have your week 5 deposits, bills, ledger, and spreadsheet. Let's look at the deposits here real quick for bills. No check to deposit. It'll be an automatic deposit into your account today. You can see in the assignment, the directions say add $1,200 to your checking account for week 5. So that should be the first transaction in your ledger this week. Again, whatever your remaining balance was, I believe it was $1,330. You're going to start by adding $1,200 to that, and then you'll go through and write the following checks for expenses. Do the deposit, write the checks, complete your ledger, make sure you update your budget sheets. I will be looking at budget sheets this afternoon, so make sure they get updated. And then on Monday, check that Tuesday, when you're back on Tuesday, you will turn in your checks, and I'll look at those again, make sure those are being completed correctly. So that is what we're going to do today after we're done talking about treasuries. All right. Yesterday, when we were back from the snow day, the ice day, whatever you want to call it, we talked bonds, right? We talked loans. Bonds come from different categories. We talked about corporate bonds yesterday. Loans sought by corporations for whatever improvements that they wanted to make, whatever expansions they wanted to make. Corporations are not the only ones that issue bonds. They're not the only ones that take out loans. Governments will also take out loans. If you're in my contemporary issues class, we're talking about the federal debt right now. The United States government, since 1835, has run a significant number of deficits, meaning they have spent more money than they had. What allows them to spend more money than they take in from taxes, right? Revenues and expenditures. What allows them to spend expenditures more than they have or collect in revenues, taxes, is funded by treasury bonds, right? It is the American citizen buying bonds from the government on the condition that they, one, will get that money back in the future. And while the government has that money, has that principal, they are paying interest. This is why the United States government right now is some $31 trillion in debt. They have borrowed money from the American people. We have bought either treasury bills, treasury notes, or treasury bonds. The only difference between bills, notes, and bonds is the fact that they are in different increments of time. Bills are 3, 6, or 12 months. Notes are 2, 3, 5, or 10 years, and bonds are 30 years. Right? Runs is the same concept as a corporate bond. You have some institution, corporate or government, that is taking out a loan. Those institutions are expected to pay interest on the loan and then return the principal in the end. Treasury bonds work the same. Treasury securities work the same way. The difference between a corporate bond and a treasury bond is taxes. Typically, you do not pay state or local taxes on federal government bonds. Typically, you do not pay federal, state, or local taxes on something called munis or municipal bonds. It's not just the federal government that can issue bonds. State governments can issue bonds. Municipalities or cities can issue bonds. Cities can issue bonds. The advantage of a treasury security, right? A treasury bond, a government bond, all the same thing, is that there are typically less taxes to be paid on them. The downfall of government bonds is because they are so guaranteed, right? Almost a sure bet, is that your rate of return on these bonds is typically lower, right? You found some bonds yesterday in the game, 9.5%, 10%, a little higher. Government bonds are typically not that high. Less risk, less reward. We do have junk bonds. We're not going to talk a whole lot about junk bonds. Just simply junk bonds are bonds that are rated pretty low, right? Most of the bonds yesterday were somewhere in the A's or B's. Junk bonds are the lower ranking B's, C's, and D's. These are loans that are sought by corporations that come with a high amount of risk, and the chance of default is pretty high on those. Overall, oops, don't know why that window popped up. Overall, we have some benefits and dangers of bonds, just like we have benefits and dangers of stocks. The benefits of investing in a bond is that you have a readily steady stream of income over the course of that bond's life, right? You are receiving an interest payment throughout the year on that bond, and then at the maturity date, when that bond comes due, you receive all of your principal back. Another benefit of a bond is that usually the bond market works in the inverse of the stocks. So if the stocks are going down, if the market is up or down, and it's topsy-turvy, the bonds offer a little bit of growth when things are going bad in the other markets. Yeah, this is another example of why we need to be diversified, right? Being in the bond market and the stock market helps us kind of resist or minimize major risks, major swings in the market. Another value of bonds, since they're directly related to interest rates, if you are in the bond market and you secure a bond at a very high interest rate, and all of a sudden the Fed starts lowering interest rates, which eventually they will start doing again, that is advantageous. And typically, you buy bonds at $1,000 increments. If you hook in at a bond at 9% interest and interest rates start going down, that $1,000 principal that you bought that bond at will actually probably be sold at a profit. People might be willing to pay $1,050, $1,100, $1,200. They will be willing to pay you your $1,000 plus additional cash to get their hands on that bond, because they're going to be paying, they're going to be getting an interest payments at a much higher rate than what the current interest rate is at the time. Do have some dangers with bonds though, right? Nothing is 100% guaranteed. Right now we see interest rates increasing. If you lock in right now at an 8% bond and the Fed comes out and says we're raising interest rates again, right? And now bonds are being sold at 9%, it's going to be problematic, right? The value of your bond will go down. It's really not that big of a deal, but again, we got to think about this. Time is always on your side. In bonds, if you buy a bond at 9% and the interest rate goes to 10, you're still okay. You're not going to lose any money. The only way you lose money is if you sell it. So again, time is on your side. If you buy a bond at X% interest and the interest rates go up, that just simply means you got to hold on to it. You'll get your principal back. You'll still get the same interest payment throughout the life of the bond. Really not that big of a deal. Is it the greatest thing? No, it sucks when you more or less buy a loan, right? You buy a bond and then, 2 days later, a month later, you find that there's a better option for you. It kind of sucks, stings a little bit, but you're not going to lose any money. And that's really the ultimate game, right? The ultimate play of why you would enter into the bonds to begin with. You're in bonds not necessarily to make money. You're in bonds to protect your assets. You're in bonds to protect your principal, right? You've made some money. You want to let it grow a little bit more, but the stock market's too topsy-turvy, right? It's a safety play. It's not necessarily an income-driven decision. We do have to be careful what bonds we're buying, though. There are all sorts of corporations that don't have great credit, that they have financial issues. They may not have a tendency of paying their debts. And again, that's what those ratings are for. Moody's, S&P, they do a good job of analyzing the financial position of these companies for taking out broad amounts of money. If we're in the A's, we're fantastic. May not make as much interest, but you're going to get your money back. And again, that's the reason why we go into bonds, is to protect our income. You can take on a little bit more risk, right? A lot of you guys went into Panama. You bought Panama at 9.5% interest, but it comes due on the 16th, right? Your next payday is the 16th. That was a short game play. Some types of bonds are callable, just like stocks can be callable, meaning that the government can call them early. They can pay it off early, right? Companies can buy back stock, right? When you're picking out bonds in the real world, you're gonna have to pay attention to see if bonds are callable. Oftentimes, if a bond is issued at a high interest rate and interest rate drops, corporations might, or governments, not governments, but corporations might try to buy those bonds back and then reissue bonds at a lower interest rate. Another problem with bonds, and again, right, while time is always on your side, in this particular case, bonds sometimes can be illiquid, meaning that you do not have direct access to cash. Your cash is with that corporation or your cash is with that government institution, and selling it early comes with some loss, right? These are not as liquid as stocks where you can get your money pretty quickly. If you're minimizing losses, if you don't want to lose the money that you have, then bonds can definitely be illiquid because your money is locked up for a period of time. That's it. That's what I have for bonds today. Excuse me. Monday morning, sorry, check that. Tuesday morning, when we come back, I'm gonna go back and finish talking about what we should have talked about earlier in the week, which was investment strategies. We'll talk about that ahead of you guys finishing up the chapter 13 reading guide on preferred stocks. So today you have your week 5 paycheck, bills, ledger, and spreadsheet. I'm looking at spreadsheets this week. Monday, check that. Tuesday, you'll turn in your checks. Tuesday, we'll talk investment strategy and then knock out the rest of chapter 13 on the shortened week. So thanks for coming in. Make sure you get your work done. Have a great weekend, and I'll see you guys on Tuesday. Go Spartans.